but a lot of people think, they can write off anything. They're always at Eve, like, can I write this off? Can I write this off? Like, I want to write this off. Like, what do you think about this? And at the end of the day, I'm always going to throw the section 162A at them. Okay. And then it says you can write off anything that is ordinary and necessary for your business. Okay. In the pursuit of income. Okay. So in whatever case you were doing, if you were in the pursuit of income, it makes sense. But again, I stress ordinary and necessary. It may, if your business made $10,000, it might not be necessary for you to go buy a vehicle so you can write it off, right? A Lamborghini to go write it off. That don't make no sense, right? Right. So at the end of the day, your goal is you have to be able to, if in the case of an audit, right? And an audit is nothing to be afraid of. If you're properly documenting your stuff, it's really just you showing and approving what you did was ordinary and necessary. And if you can legitimately make that ordinary and necessary for your business, then you're in the clear.
You're listening to the Black to Business Podcast, an educational podcast providing Black entrepreneurs with the tools and resources to start and grow their businesses. We chat with vetted Black entrepreneurs, thought leaders, and business owners as they provide tips and resources to help take your business to the next level. I'm your host, Moni T. Marshall. Hey, welcome back to the Black to Business Podcast. I'm your host, Moni T. Marshall, and today's episode is truly a masterclass conversation. We are talking about all things business taxes, but the good news is we are making it simple because let's be real, taxes can be a headache, but we know we need to do them, and understanding them is the key to keeping more of your hard-earned cash and making smart business moves. And it's not just about filing your taxes. It's about proactive planning that can significantly reduce your tax liability and keep you ahead of financial pitfalls. Today's conversation is all about arming you with the tax knowledge you need to set up a solid financial foundation. We'll be covering everything from understanding tax credits and deductions, and even how the right business structure can save you serious money. You'll learn about common tax mistakes every entrepreneur should avoid and discover some game-changing strategies like the Augusta loophole and income deferral. Our guest today is none other than Ibrahim Mohammed, a dedicated tax professional on a mission to help small business owners streamline their accounting processes, saving them time and money. With a goal to help businesses save 5 to 7 figures in taxes, Ibrahim merges a wealth of experience in both corporate and entrepreneurial worlds. He's here to debunk common misconceptions about taxes and guide you through powerful tax saving strategies. So whether you're just starting out or you've been in the business game for a while, this episode is certainly for you. So as I mentioned before, get ready to take some notes and let's get into this masterclass. Glad to have you on the show, so welcome.
Thank you. I appreciate you for having me. Super excited to be here.
Yeah, I'm excited for you to be here because we are talking all about some simplified tax strategies, tax saving strategies for entrepreneurs. And I know you're the guy for that. But before we dive in, I'd like to kind of intro my guests and let my audience know who's on the podcast. So if you could just share briefly a little bit about your background, how did you get here, and what is it that you do in your business?
Yeah, absolutely. Born and raised in Chicago, Illinois. Family's from Nigeria, so actually I was born in Chicago, ended up living in Nigeria for about 4.5 years. So at a young age, I think I was like 4 or 5 years old. Both my parents are both immigrants from Nigeria. Ended up moving back, lived in Lagos, Nigeria for about 4.5 years till I came back when I think I was like 9 years old. And really just started, I was really an athlete. I played soccer, then I transitioned into football around my junior year in high school. And, I grew up in a traditional household to where my parents are very big on, like, my mom, a strong accent. She's like, you're going to go to school, you're going to get an education, right? She's like, you're going to be a doctor. So I have if you know any Nigerians out there, that typically they either go to school for engineering, they go to school to be a doctor, along those lines. A lot of lineage of nurses. That was what was poured into me. But around my year, I did well, and I did pretty good in football. Went to my senior year, actually was able to start. I transitioned from soccer to football, did really well there, and I got a scholarship to actually play at Ashland University out here in Ohio, which is a Division II level. Then I transitioned and transferred to the University of Akron, where I ended up graduating from, and I decided to play. I was able to play Division I football at the University of Akron. And while I was there, I just knew I couldn't be studying anything crazy. It had to be something along the lines of what my parents would be proud of, and it was accounting. So I studied accounting and, did really well while I was in accounting, ended up graduating straight out of college, went straight into the corporate arena, worked for a lot of Fortune 500 companies, went back to my master's in business because, I wanted to go be able to sit for my CPA exam, become a licensed professional, and get into the accounting industry. But, I found myself 7 years into my career at the corporate level, bouncing from position to position. And just realized that I wasn't the reason why I ended up with 5 different companies within, a 7-year time frame was because I was thinking it was going to get better by me going to find a company. Right. And it didn't. And I realized I was on the inside, I was had a burning desire to become an entrepreneur. And that was the route that I ended up taking. Right. I had that hunger for it. And long story short, I ended up, started up my own accounting firm and started scaling it. And it just felt like it was where God was putting me to be able to actually have influence on my community and be able to actually help teach people about ways on how to be. I mean, it's a universal language is money, right? So how can I show you how to eat money? And that's what I got excited about, being able to help people in that industry.
Yeah. I love that you shared that story. And I think that even I personally can relate to that. And I'm pretty sure many listeners can relate. It's like, no matter what you do or what career you go into, it's like deep within you, this is not what I'm meant to be doing. Yep. And I think that as entrepreneurs, we always kind of know like this isn't going to be forever for us.
Yep.
Yeah.
It's battle on the inside. You're just like, I think I was called for more.
Yeah, definitely. So thank you so much for sharing that. And I want to go ahead and dive into today's discussion at the Black to Business podcast. On the Black to Business podcast, we always like to break it down and understand the basics. So for many entrepreneurs that are listening, I think we always hear about taxes, don't let the IRS come from you. And so for more people that they're scared or they're like, okay, what should I be doing? So before we get into all of that, let's understand the basics. So what are some of the basic principles of tax saving strategies that every entrepreneur should know that you think?
Yeah, absolutely. I mean, it can't get as basic as just proper documentation. Every business owner needs to be documenting something, right? And it's crazy how I talk with entrepreneurs and, I say, well, how much money are you making? Well, I don't know. Well, how much money, like, what's your net profit? Well, I don't know. And it stems back to proper documentation, right? So many business owners don't have an accounting system. Like they're not documenting their income. They don't know their expenses, which means you don't know what your net income. And that's the bottom line on how you get taxed. Right. So really, it starts off with documentation. You have to understand like how to track your income, how to track your expenses, so you can be able to leverage and start to claim, different deductions and credits, right? Because where your money's coming in and out from. And then I know we'll get into the discussion, but then I believe, tax planning, right? Being proactive and learning different strategies that fit your business needs to be able to actually put you in position to save a lot of taxes. And then the last foundational one is like, how is your business structured? Right? Do you have the proper legal structure for your type of business that's giving you opportunities to be able to lower your tax liability and give you more opportunities for savings?
And there you have it. Yes. And speaking of, one of the things you mentioned was deductions and credit. So can you explain the difference between deductions and credit and how they apply to small businesses?
Yes, I love this. I love this question because a lot of people don't understand. They both have benefits. Okay. And you want deductions and you want credits. But the way tax deductions work, for example, they lower your taxable income. Okay. They lower your taxable income, and you based on that taxable income and your tax rate based on the tax bracket where you are, whether you're filing individual, whether you're filing married, filing jointly, separately, whatever, right? That's what you're going to be taxed on. For example, let's just say your business made $100,000. and you had, you accumulated a bunch of deductions from, your vehicle, your rent, utilities, things like that. And you had deductions of $20,000. Okay, now $100,000 minus $20,000 deductions, now you're at $80,000. That $80,000 is what you're taxed on based on where you're at on the tax rate. So it just reduces the amount that you're taxed on. Whereas a tax credit is like almost like a discount. It reduces your tax liability dollar for dollar, right? So let's just say, okay, just in that same example, okay, let's say you had to, $20,000 in deductions. Now you're taxed on $80,000, and you get a tax bill of, let's just say it's $10,000, right? You get a tax bill of $10,000, but you find out you qualify for a tax credit that's worth $2,000. That means that $10,000 that you owed after the number was calculated minus that $2,000 tax credit, now you only owe $8,000. It immediately reduces your tax liability, right? So credits are like, it's a dollar for dollar, comes out immediately, whereas deductions is lower the amount that you're taxed on.
Plain, simplified, love it.
Yes.
All right. So how can people who are very new, early stage, start to identify those tax saving opportunities within their businesses?
It's 2024. Education, you can find it anywhere, right? That's one of the things that I pride myself on as a tax professional is you look all over my social media. My whole goal is educating on new tax law updates, on different ways you can save, hundreds of thousands of dollars on your taxes. And you go on YouTube, you can find education everywhere. There's a lot of courses out there. Now, granted, it might be a little bit saturated. You want to make sure you're careful on what information you get, that's out on social media. But there's a lot of information out there. There's a lot of credible people that are out there, and it's for you to get, and it's also for you not to get, right? It's very easy to find. And it's also very not easy to find. So that's the first thing. There's a lot of education out there. But the biggest thing, I think more people, they need to find a tax professional sooner than later. Right. Most people wait. They want to do a lot of things on their own. As entrepreneurs, we want to do so much things on our own, be that solopreneur, and then we get burnt out, and it leads to some negative things, right? Like you potentially losing your business. So I think new entrepreneurs, as soon as you can talk with a tax professional, whether it's a CPA, an enrolled agent, a tax strategist, whoever they are, the sooner they can provide you that. I mean, that's their specialty. Their specialty is understanding the tax code, understanding finances, how to account for things. So why not you focus on what you're good at, whether it's your restaurant business or you're a physician. Why don't you focus on that and let a tax professional manage the numbers and provide you the right guidance? And that's probably the number one thing is more people should seek tax professionals sooner than they can. And then really at the end of the day, it goes back to, tracking your expenses, right? Tracking your expenses and understanding when you need to be reviewing, whether it's quarterly, whether it's weekly, monthly, yearly. Maybe it's all of the above to understand what your true, what does your business look like and what's the projections for the future.
And I like that you said sooner rather than later. So we have a lot of early stage. A lot of people, I myself was a first generation entrepreneur. I had nobody in my family that was a business owner. I didn't know half of this stuff. So for somebody like me, when I was just starting out, what is sooner? When you got the idea, when you got some money, because there's also the thing about a lot of people running hobbies versus businesses and all of those things. So what's soon? Yeah,
absolutely. That's a great question. And I think soon is your first year. Okay. Your first year, because I think a lot of people say, well, I'm just not making money yet. But most people don't realize that you can write up to $5,000 in your startup cost, and you can amortize that over the next 15 years. So they don't track anything. Maybe it starts off as a side hustle. That's what the tax code is almost like a cheat code for people who have a W-2 income, right? Because now you can offset all the taxes that you paid out throughout the entire year with your expenses from your business. Carry that over. And now you can knock it all up. That's how people get big refunds. So I say sooner because once you start a business, honestly, I believe that first year you need to contact a professional. Definitely before you file. Let's say you started your business in January per se. I would hope you contact a tax professional by July, just because now that's the next season we're going into, to where you can actually start to see, okay, what are my plans for the next year? What can I do to be able to, what's my strategy going into this next tax season to put me in a better position? So that's why I consider it soon.
Mm-hmm. And for a lot of people, they are, like you said, a tax professional, stressing a tax professional versus your local, maybe won't name the business. But what is the benefits, or why is it so important to seek out a tax professional versus going to these one-stop shops? And also, on top of that, budgeting for seeking a tax professional.
Yeah, I think it's so much. A lot of people, again, they can do it on their own. They could go to the Terrible Taxes of the World, the H&R Blocks, the Tax Free USA, and just to give you perspective, I can't tell you how many people I've run into who they're doing stuff on their own, and it's because and I look at the returns. I'm like, well, why don't you take this deduction? Why don't you take this one? They don't know, right? Because the platforms, granted, they're set up to help they ask you questions to be able to help you try to figure out what your situation is, right? But they're pretty standard questions, and everybody's business is not the same. Everybody's business is different. Your situation is different from the next. Whereas these platforms are geared towards the overall population. Whereas when you talk to a tax professional, like my clients, I want to know, I want to know the whole entire situation. Like, what are your goals? I want to know the history of your business, where you're trying to go, right? And now we can implement it. And I want to understand your industry. Let's do some research on your industry and what are other people utilizing. But it doesn't go into that level of detail when you do it by yourself, for one, and you miss out on stuff. And when you go to a platform that, at the end of the day, I mean, there's millions of returns that get filed between January and April. So you could become just another number and miss out on stuff. And the IRS don't care. Like, oh, you missed out on that. Okay, we'll take the money. Right? They don't keep their money. So you have to do your due diligence, and I recommend finding a tax professional who has results and is actually detailed, because there are some tax professionals out there, and they do, like, there's some CPAs that they just want to get the returns done. They're doing so many returns, you give them paperwork, they get it done. They're not doing any sort of tax strategy. And granted, the tax strategy should come before the year end. So don't go to your tax professional January, February, like, what can you do? I mean, it's too late now, right? Now it's more reactional versus being proactive.
Yeah, I love that advice. And speaking of being proactive, so still sticking to the basics. So in your experience, what are some of the specific tax considerations people should be keeping in mind, like things that people aren't thinking of, but they should be thinking of?
Yeah, I think it's 2024, right? Ever since COVID, things have changed. There's more and more entrepreneurs that are working from home. There's more and more people working remotely. The biggest thing that the old school accountants versus new school are noticing is the fact that you can utilize like a home office deduction, right? You can take advantage of a home office deduction where you can get a portion of your home, and you can write off a portion of that area in your home as a tax write-off, right? And there's a couple methods. There's a simplified method, and there's an actual expense method. Simplified method, you take $5 per square foot of your home, and you can get up to 300 square feet as a tax write-off. Max is like $1,500. Whereas you can do the actual expense method, where you can be able to write off direct expenses and indirect expenses. So you can write off things like your utilities. You can write off things like your mortgage interest, things from home improvements and home expenses. So you have to weigh the cost and see, okay, what makes the most sense for you, and talk with a tax professional and see what's the best strategy based on your situation. But so there's a home office deduction. There's retirement. I mean, we're entrepreneurs. We don't want to work forever. That's why we wanted to be entrepreneurs, right? We wanted to have our own terms. So, okay, just because you're not working for an employer anymore doesn't mean you don't need to save for retirement. Like, typically they have, employer plans. But there's different things like a SEP IRA, right, that you can invest in. There's things like a solo 401k with retirement that you can invest in. And they're geared towards self-employed individuals. And those are like the two simplified ways that where I believe people are missing out on. And there's a couple that I'm sure I'll talk about here soon. But those are a few that just stand out to me off the jump.
Okay, that's good. That's good. And so we always are about how can we avoid some of these mistakes. So let's get into the common pitfalls and misconception. So, Ibrahim, what are some of the common tax mistakes or pitfalls that entrepreneurs should avoid?
Yeah. Number one is mixing your personal and business expenses. Um,
Mhm.
like
That's a big one.
I need you to go and open up a business bank account like as soon as possible.
Yes.
Stop using your personal credit card to your personal business card to purchase all your business stuff. Now, granted, can you still write those things off? Yes. I mean, it's for business, but from a record keeping perspective, right? Well, like you don't want the IRS to come in and start to question anything, right? So it's like, well, how you mixed it up with this? Like, well, what was this purchase? Oh, you got your hair done here. How does that relate? Like, you start to mix up so many, and now you have to start to question, like, what do I spend my money on? Whereas if you have a dedicated business bank account, or as I recommend, a couple business bank accounts, you can start to know where your money is coming from. And that's how you budget, where you don't overspend on specific things. And now you can track and see, okay, how am I tracking on my deductions, right? How am I tracking on making my estimated tax payments? How am I making sure I'm not missing out on tax deadlines? That's another thing, right? Most people, if you're paying estimated tax payments, do you know that those dates, right? And they vary every year to year, but do you know when you're supposed to make those payments? Missing those deadlines can lead to some more charges or penalties, right? But when they're overlooked, because again, it starts off, I'm gonna beat the dead horse, but you're just not tracking your stuff right.
Yeah.
And you're so busy, you don't have the time to do it.
Yeah.
So hire a professional to do it for you.
Yes. And the great thing about a lot of online banks, or just banks, just online banks, I know for sure, they do buckets now. So you can put a lot of your money into different buckets and categories. So that's good.
Yeah.
And what are some of the common misconceptions about taxes that you feel that many entrepreneurs have?
Oh, that's a good question. I think most entrepreneurs believe that and it goes back to what I talked about before, but they believe that hiring an accountant is really only for big businesses. It's for people who are actually making money. Right. That's the biggest thing I hear. It's like, well, I'm just not making any money. I was like, well, you're probably not going to make any money if it's all going to taxes. Right. So that's the biggest. It's like, oh, it's only, I have a small business. I only made, net profit $10,000. Like, I'm not ready. I'll just file my taxes on my own. I'll just take care of it on my own. And that's great. You might save a couple dollars in your mind, but then if you would have gotten with a professional sooner, he could have showed you potentially something that you might have overlooked, right? Because he studies it, and he can, guide you through the path. That would be the number one thing. And then I would say the next thing is, and I run into it a lot, but a lot of people think, they can write off anything. They're always at Eve, like, can I write this off? Can I write this off? Like, I want to write this off. Like, what do you think about this? And at the end of the day, I'm always going to throw the section 162A at them. Okay. And it says you can write off anything that is ordinary and necessary for your business. Okay. In the pursuit of income. Okay. So in whatever case you were doing, if you were in the pursuit of income, it makes sense. But again, I stress ordinary and necessary. If your business made $10,000, it might not be necessary for you to go buy a vehicle so you can write it off. Right. A Lamborghini to write it off. That don't make no sense. Right. So at the end of the day, your goal is you have to be able to, if in the case of an audit, right? And an audit is nothing to be afraid of if you're properly documenting your stuff. It's really just you showing and approving what you did was ordinary and necessary. And if you can legitimately make that ordinary necessary for your business, then you're in the clear. So that's the biggest thing, is understanding and stressing. And one of my phrases, like, I help business owners save 5 to 7 figures legally and ethically. Right. So I believe whatever you give is what you get. Don't try to, take the shortcut of, trying to write off a whole bunch of things that, for sure probably is not going to put you in a bad position. And it's probably not a tax write-off. Right. And just be reasonable with how you would actually go about explaining it.
I love that advice, and I love the fact that you talk about, like, in that, the risks of not properly managing some of these obligations. So let's get into that. In your experience, I know you work with a lot of clients. So talk about the potential risks of not properly managing tax obligations.
Yeah. So when you don't, like, this could lead to some penalties, right?
Mm-hmm.
It could lead to major penalties and interest. And a lot of people, when they realize, oh, I screwed up and I didn't manage it the right way, typically they file extensions, right? They'll file an extension, mm-hmm. and you'll have to October to file your extension, or September. And now you have to, you're looking at your situation like, okay, what do I got to do? And now it's accruing interest, right? If you owe mm-hmm. money, it's accruing, and you're getting all these penalties. And most business, depending on your structure, there's several different structures, from sole proprietorship to an LLC to an S corporation to a C corporation, to where if you're structured a specific way, now you have to be compliant with that structure type. And if you're not managing it in that proper way, you can face some tax obligations, right? And honestly, that could even throw some red flags to where you do get audited. Mm-hmm. So you have to understand your business structure. You have to understand how you're managing your taxes to put you in a position to where you don't get flagged for an audit, right? Because you do have the good record keeping, and now you're not afraid. Like, I'm not afraid of an audit because I know what the work that I've been doing and how I put myself in position for my business to be represented. And then at the end of the day, it's like, what do you want your reputation to be as, right? When you're meeting, mm-hmm. trying to grow your clientele, right? Or when you're trying to get access to funding, right? That's what a lot of people I run into. They want to get access to funding. So now they're running to me. It's like, well, I got to get my financials together and I got to do all this stuff. So mm-hmm. let's do the proactive work to stay compliant. So when the time comes, we're ready, right? We don't need to look around. Hey, just call my accountant, get it done.
Right. Stay ready so you don't have to get ready.
Yep.
Yes. And we've talked about tax professionals, and one of the things I love that you speak about is that educational aspect of things. I want to talk about why understanding these things for ourselves as business owners is important, although we're not tax professionals. So how can, for example, understanding IRS guidelines and regulations benefit entrepreneurs?
Yeah, I think it's very important. It's almost like, I'm not going to go see a doctor if I know he didn't educate himself on how to perform surgery or how to diagnose me with something. It's the same thing of just doing due diligence with, whatever it is you're doing to stay compliant. And even if you think about it, most professionals, they have to take different classes to mm-hmm. keep their certifications. Right. I believe every business owner should almost have that mindset to have that continued education. Like, the worst thing I've heard before is when somebody's graduated high school or graduated college and just like, yeah, I don't even want to learn anymore. Like, it's like, I'm not picking up a book anymore. I'm not trying to. That's the worst advice. Like, I want to die learning, and that should be the mindset you have with your business, to where you're always mm-hmm. trying to stay compliant. Right, you're always trying to stay compliant. You're always looking for different ways to improve, to make sure that you're staying within. When we talk about the tax perspective in the IRS guidelines, because the tax code changes every single year. Mm-hmm. We're getting ready to go into elections. There's going to be some changes that potentially happen. So always staying updated with what is going on, because it could affect your business. And that is in a very important part, to where you want to be involved. You want to understand the risks that can come with whatever may be going on in the economy to your business, and you understanding that, and the stakeholders of your business or investors in your business, or whoever the case may be, you now are aware. You're all aware to where you can make decisions to actually help you grow your business.
Mm-hmm. Yes. And now I want to get into some of the strategies and step-by-steps for minimizing tax liability. What are some practical steps entrepreneurs can take to minimize their taxable income?
Absolutely. Let's start with some basic. Let's talk about a vehicle deduction, okay?
Okay.
So one of the things that you can, there's Section 179 deduction, okay?
Okay.
Section 179 deduction, you're able to actually, it allows you to write off the full purchase price of qualifying equipment, vehicles, and software mm-hmm. in the year that you purchased it. Okay. So typically there's an average life, and when you talk about different depreciating properties, like vehicles, because it's a depreciating asset, or mm-hmm. Real estate, those are depreciating assets. they typically have a useful life, right? So equipment, vehicles, software, those typically have a useful life of about 5 to 7 years. So you get to deduct a portion of that for a total of 5 years. So if it was $5,000 of a piece of equipment that you got, and you have 5 years to depreciate, you would take a portion of that $5,000 every single year. But with Section 179, if it qualifies, you're able to write that off in the first full year to help offset some of your business expenses, right? You can qualify to make that in a year. So that's why you see a lot of people who, there's vehicles that qualify for Section 179 or vehicles that are over 6,000 pounds.
Mm-hmm.
If you purchase a vehicle, even if you finance it, that purchase price, let's say it was $100,000. If it's over 6,000 pounds, you have the opportunity to accelerate that depreciation and take the full $100,000 deduction in that first year.
Mm-hmm.
Right. So that's why you see people towards the end of the year where they're looking for, G-Wagons, right? They're looking for, the Mercedes that qualify, right? So that's one of the biggest ones to where, again, I'm not in the business of saying, let's just spend a bunch of money, but if it makes sense, okay, let's not just give it to the IRS. Let's utilize it. If you're going to utilize that vehicle for business purposes over 50% of the time, okay, let's figure out what makes the most sense for your business. That's ordinary and necessary, right? It makes the most sense, right? So that would be, that's one, okay? I think another one that a lot of people are not familiar with, and I think it's maybe getting some more attraction to, it's called the Augusta loophole. You ever heard of it?
No, I haven't. Okay,
so the Augusta loophole, it's pretty much a bigger version of the home office deduction. Okay, so what the Augusta loophole is you're allowed to it allows homeowners to rent out their personal residence for up to 14 days per year without having to report the rental income on their tax return. Okay, so you can rent out your home for up to 14 days. So this actually started off, I don't know if you watch golf at all, but this actually started off in Augusta, Georgia. So
yeah, I'm from Georgia, but I know Augusta. I don't watch golf.
Oh, you know Augusta. Okay, so that's where it started. So they host the Masters out in Augusta, Georgia. Right, and the Masters is a big deal. There's I think it's 46 to 48,000 spectators per day that come out to watch that. So I mean the hotels are overloaded with people coming and visit. So what the government allowed was people in Augusta, Georgia, to actually rent out their homes to people who are coming to visit for the Masters. And they were able to not have to report that rental income on their tax return.
Oh, wow.
Right. And now they can rent it out for a reasonable price. So if they're charging, in the area, like your hotels, they're charging $1,000 a day. Okay, you could take $1,000 and rent it out. And if you did it for 14 days, that's $14,000 of a tax deduction that you can have that you don't have to recognize the income on.
So, we are learning today all the things. I love it.
Yeah. So I have some steps on how to actually go about it and doing it the proper way. But it's one of the biggest ones that I think most entrepreneurs can leverage. And if you want me to dive into it, I can.
Yeah, that's so good. Oh, wow. That's all the tea. So any other things we should know about?
Yeah. Let's see. I think if you're a high income earner, okay, you're a physician, you're a doctor, you're, a professional athlete, or you make a lot of money, right? I think the biggest way to actually help you build wealth is through real estate, and help offset a lot of your income, because there's things from accelerated depreciation, like we talked about, because typically let's say you want to buy a property, right? You could buy a property, there's residential and there's commercial. Right, residential, you have a depreciation where you can write off a portion of that home, whether it's for let's say it was $500,000, right? You have for a residential, you can have a deduction of about, I think so it depreciates over 27 and a half years. Okay, 27 and a half years, and you take I think it's like $18,000 per year as a deduction. Okay, that you get automatically for 27 and a half years. But and then on the commercial side, it's 39 years. So now you're getting that deduction, for 27 and a half years, 39 years, but with the accelerated depreciation, you can accelerate that. So you don't have to wait 27 and a half years. How can we accelerate it and take that $500,000 within the first 5 years, right? Mm-hmm. So you can take advantage of that. And there's different ways on you to be able to qualify for it, because there's a difference between the land and then the building. Mm-hmm. And let's say it's $500,000. Okay, there's another strategy called the cost segregation study. And with the cost segregation study, you can actually take the components of the building, the land improvements, the personal property, the lighting fixtures within the home or the property, just all the things within it. And now with that study, you have an engineer come and do a study for it, and we can break it down. Now they found some equipment, they found some land improvements within that. So it's not just $500,000 that you can use as depreciation. You have, a $5,000 fixture in there that you can depreciate. You have all these different things that qualify, and now that's more deductions that you can speed up and accelerate to take a deduction sooner rather than 27 and a half or 39 years. So cost segregation studies is a really, really big thing that a lot of accountants are starting to implement to be able to help a lot of high net individuals offset their income.
Yeah, that is free game. So much free game there. I love it.
Oh, yeah.
And so one of the things I love that you also mentioned earlier is the business structure. So making sure you have the right business structure, all of those things. So how does choosing the right business structure impact tax liabilities?
Oh, man, this is a great question. I wish more people would understand this. So I'm going to try to help it make sense. Okay. Mm-hmm. So we have sole proprietors. Okay. So the sole proprietor is like, you just wake up one day, you want to start a lemonade stand. Okay. Mm-hmm. You open up the lemonade stand. You can go out today, and just start making money. Right. You'll be considered a lemonade stand. It's easy to operate. It's all taxed at the individual level, which goes on your 1040. Okay. And I might talk some tax terms, but everybody has filed a 1040. Everybody who has a pulse and can breathe, you filed a 1040 before. It's your individual tax return. And sole proprietors, that's what it's going to end up moving through. Okay. You go on a Schedule C. But then there's partnerships. You have partnerships, and partnerships is okay. That lemonade stand that you had, you went in on it with the buddy, and y'all wanted to split the profits 50-50 or 41, or 49-51, whatever the case may be. But now you have to file at the end of the year a 1065 form that now issues you a Schedule K1. So let's say it's 50-50. You guys made 10 grand. Okay, that's 10 grand in profits that now you're going to split between your partner. Okay, so he takes 5 grand, you take 5 grand, and you report that on your individual tax return. Okay. And then there's LLCs, and LLCs offer the most flexibility in how you're taxed, because I like to say you can upgrade or you can downgrade. You can be taxed as a sole proprietor, or you can be a partnership, or you can be a corporation, right? There's a lot of strategies of people electing to file as an S corporation. Okay. But it has the most flexibility. Plus, it provides with you that liability protection. There's no liability protection when you think about sole proprietor. Right, you're running the business, and something bad happens, you can get sued, and they're coming for your personal stuff. Right, whereas you can separate it with a limited liability company, and based on your net income, you can decide what makes the most sense for you to file from a tax perspective. Sometimes I see people are too soon; they're set up as C corporations way too soon, or S corporation way too soon. Right, so understanding when is the right time for you to make that shift, LLC provides you the most flexibility. And then you have S corporation, where again income is passed through to the shareholders. So you have shareholders at that level, and the reporting is a little bit different. You have to do like annual reports. You have to, you have to have annual meetings and whatnot. So the reporting is a little bit different, but it's still it avoids what we call the double taxation that I'll get to in here in a second. But pretty much you have to fill out an 1120S form. It's a different form, and that form, whatever the profits may be or the losses may be, they get distributed to the shareholders via K1, and now that's what you have to report on your personal tax return. Okay, and again, that's how we can avoid some double taxation, because the last one is a C corporation, and a C corporation is double taxed because they have to automatically pay income tax at the corporate level. So if your business made a net income of $100,000, I think the corporate level rate right now is 21%. You have to pay 21% on your net income. Plus, you also got to pay at the individual level based on your distributions or your dividends that you had. So that's where you get double taxed. And sometimes I'm seeing people, they're double taxed. I'm like you should not, your structure should not be this way. You need to understand. And this is what I recommend. Okay. So when you start a business, right, just start the business. That's all. Just start the business. It started as a sale, so start the business, start to collect some of the write-offs. But I say get that LLC as soon as you possibly can. Get that LLC, get incorporated, so you have that protection. But once you start to generate a net income, and I'm saying this, net income, not your revenue. You have to know what your net income is. Once you get that ballpark of anywhere from $40,000 to like $60,000, okay, maybe you want to consider electing to file as an S corporation, right? Get an upgrade to an S corporation, because you're gonna avoid that self-employment tax, that 15.3% self-employment tax that is coming for you, right? And sometimes it doesn't make sense for you to still be an LLC if you're between that 40 to 60K net profit. So then upgrade to S corporation, and now we can manage it that way. But then once your business is exploding and you're generating $400,000 to $500,000 of net income, it's time for you to become a C corporation, right? And again, it could be different for different businesses, but that's typically my framework a little bit of when I start to think need to upgrade based on the structure to be able to lower the tax liabilities.
Solid advice. That was just a masterclass all within itself.
Right.
Yes. And Ibrahim, what is income deferral, and how can entrepreneurs use it to manage their tax liabilities?
Oh, yeah, absolutely. So income deferral is pretty much you practicing of like postponing the income that you're going to be making into a future year to reduce your taxable income in the current year. So entrepreneurs, they typically, maybe they want to delay some invoicing, right? You have some invoices that your clients typically make. So maybe you date them into the future year. You delay receiving that income, working with your clientele, your customers, and delaying it to the new year, right? So you're not getting all that income in December or in November, right? So you can utilize that strategy. But then also some of my clients, they'll even accelerate some of their expenses, right? So they have some expenses coming up. Okay, how can we get those expenses and move them up into 2024, right? How can we move them up to where we have more expenses in the back half of the year and we delay our income as well, right? Also, even like retirement contributions, you can contribute to your plan as much and max it out, right? So you can actually have more expenses in the current year versus it flowing through and starting off the new year where you have, you're making those contributions. So that's really what income deferral is, being strategic with when you're receiving that income, right? And maybe pushing it out to the following year, or maybe accelerating some expenses and some contributions in the current year to lower your taxable income, so you don't have to pay as much in taxes that year.
Got it. Now let's get into some planning. So why is it important for entrepreneurs to start to plan for tax efficiency throughout the year rather than just waiting for tax time?
Yes, I love this question. So that's the area in which I am very, very focused in helping entrepreneurs today. Success is a planned event. Okay. You're not just going to show up if you don't have a plan. And the reality of it is there's really 2 to 3 tax seasons. Okay. I'm gonna start with 2 and maybe I'll talk about the third one later, but the 2 tax season from January to April 15th, when the deadline is to file your taxes. That's the first tax season. But the second tax season starts from May till the end of the year, right? That's tax planning season, where you need to be putting yourself in position and understanding what your liability is going to be going into the next year and how can you lower that. That's proactive saving. That's you being able to put yourself in position to where you understand your cash flow. You're managing it the proper way to know that you have enough to be able to pay that tax bill. Maybe you're making estimated tax payments, or maybe you know that you're going to have a significant amount of expenses that you're purchasing today that we can plan out for it. But tax planning is going to look at the overall perspective. Do you have kids, right? Maybe we want to put the kids on payroll, right? Let's find them a job to where you can write off up to the standard deduction, which is $14,600 to be able to offset some of your income. Okay, let's find them something. Let's give them a job description, right? Let's plan that out. Or maybe how many do you have? Okay, how are you going to file your taxes? Are you going to be single? Are you going to be married? Are you going to be head of household? Okay, let's plan that out. What are your retirement goals? How much money do you want to have saved up? Let's look at those. Okay, let's look at some loopholes, like we talked about the Augusta loophole. But it's tailored to you to where we figure out what makes the most sense for you in your job, in your position, in your age, your life, and how much do you want to live comfortably at the end of time when you decide to retire, right? What does that look like for you? That's what tax planning looks like. It's an overall perspective where you get with the tax planning, a tax strategist to actually walk you through all those different things.
Mm-hmm. And since we're on that, so you mentioned the different seasons. So how often or when do you recommend business owners file? Is it you recommend them multiple times a year or just once a year or at different stages?
Yeah. That's a good question. And I think it depends.
Yeah.
Okay? So I typically say the faster you file your tax return, the less chances of you're probably going to get audited. Okay, so why do I say that? How if we think about it, at the January, I think the IRS opened up January, I believe 20, maybe 16th. It was the end of January. I forget the date, but so many returns. That's when the majority, because a lot of people want their refund, right? So they're filing, they want their refund immediately, so they're filing right there. So I typically, it has to go through a process first where if you're applying with the millions, I mean, the chances of you getting audited during that time with the rest of them is less likely than if you're trying to do them right now, right? IRS is already, they've passed the time. If you haven't even filed yet, there's probably more eyes to be able to watch what you got going on, right? So I 100% recommend well before the deadline, right? Well before the deadline of April 15th, because obviously you don't want to. You don't want to accrue interest. You don't want to get any penalties. But in between that time frame from February to about February and March, those should be the times where, and again, it should be seamless if you've been tracking stuff throughout the year, if you've been tax planning throughout the year. It shouldn't take long. Different times where it has to take long is because we're playing catch up now. We're being more reactive. We have to go backwards. We got to look at all your bank statements. We got to look at, okay, was this a deduction or was that a deduction? Were we missing this? And then you're way reactive and it takes too much time, right? When you can be more proactive and it can just immediately happen once you get with your tax professional or if you do them on your own.
Good. And so back to the planning part of these. So what about some tools and resources that you recommend for entrepreneurs to kind of simplify this tax planning process?
Yeah, I recommend everybody has an accounting software. Okay, so an accounting software that could be QuickBooks. That could be, you can utilize QuickBooks, you can utilize Xero. There's Wave, there's FreshBooks. There's so many different things where you can actually keep track of your income, your expenses. You can generate some financial reports to see your income and your profit and loss statement, right? You can see your income statement. You can see your balance sheet. You can see all these different things utilizing these platforms. And they have so many different packages to where you can get, it's very, very cost friendly in these softwares. And the thing, I utilize QuickBooks a lot for myself and my clients. But there's ways where you can track your mileage with it, right? That's another thing. When you're trying to write off your vehicle, there's the actual expense and then there's the mileage expense. Great things about like apps like QuickBooks is they actually have a tracker on there. So as soon as you get in your car and you're driving somewhere and you get to that location, you maybe meeting with a client, okay, it literally tracks it to you. You can swipe right. It's almost like a dating app. You can swipe right and swipe left, business or personal. And now you have it because that's 67 cents deduction this coming year for your mileage. So now you're tracking your vehicle stuff. You're tracking your business expenses. You're tracking your income, your cash flow. So I highly recommend utilizing one of those apps, whether it's QuickBooks, whether it's Xero, whether it's Wave or FreshBooks. And then when thinking about that from a mileage tracking, I have all of my clients tracking their mileage. So whether you're utilizing QuickBooks or MileIQ, there's another app called Driver's Note. Those are different things where you can be able to track your mileage. And then from different, receipts, obviously you could track all your receipts through QuickBooks or Expensify or Receipt Bank or Shoeboxed. So I like to say, okay, once you get that receipt, okay, let's write the purpose of it maybe on that receipt in the front, right? Put it at the bottom, sign it, or just take a picture of it, write immediately, and now you don't have to keep it, right? You go put it in a box if you want to, right? And just have it all there. Because really the receipts are there in case of an audit. Right. To where you can actually prove everything. So as soon as you spend that money, okay, let's write the purpose of that, take a picture of it, snap it. Now it's saved away and you can go about your day. But again, it's very easy to do and it's very easy not to do. But
Mm-hmm.
you have to, if you want to lower your tax liability, if you want to start to build wealth for yourself, these are the things that you have to either delegate it to somebody or start to pay really a good attention to it. And that's a part of the tax planning, tax planning strategies that go about when you work with a professional or when you're thinking about doing it for yourself. And there's a lot of different opportunities for education out there where you can learn about tax planning. I even, a lot of my, I offer some different spreadsheets and templates for a lot of my clients and my audience just to be able to have access to. And now they're not out there alone trying to figure things on their own. Right. I explain a lot of it through my templates and through my spreadsheets and whatnot.
Yes, I love that. And one of the things that's so important that you've mentioned throughout the conversation is record keeping. So how long should people be keeping their records?
Yeah, I typically recommend anywhere from 3 to 6 years. If you have, because IRS can go back. So you want to make sure that you're putting yourself in position to where you have it all there. But I would say if you have it that's the beautiful thing about going online and cloud. I know I still have clients who they want to give everything to me in paper, which it's very hard to find. But there's different clouds where you can do a quick search and you can find things from 2020. Right. And you can be able to go back and find whatever it is that you need. But I typically recommend anywhere from 3 to 6 years. Your situation may differ, but that's a good rough ballpark. After that, I mean, at that, I would have hoped you would have filed by then, or the IRS is going to go in and file for you. But yeah, I would say that's a good range to be able to make sure that you're staying efficient, you're staying accurate, and you're ready, in the case of any audit.
Yes, solid. Ibrahim, this has been amazing. So I want to get into the work that you're doing and some continued support that you have for our audience. So if you could talk more about the services that you offer to help entrepreneurs with their tax and accounting needs.
Yes, absolutely. Absolutely. So yeah, I actually run a full service tax and accounting practice to where we want to help business owners in all areas. And that was my whole goal. I wanted to be able to meet people where they were at and help them, whether it's actually getting incorporated. Maybe you need to set up your business. You're just getting started. You don't know if it's LLC makes the most sense for me, if S corporation, if a C corporation, right? So we assist with the business formation things. We assist with the accounting and the bookkeeping of actually taking it off your hand, help you focus on what you do best, which is growing your business, as we focus on the day-to-day, the accounting and the reporting, right? Helping get the reports ready so you can go get access to the capital, get access to the funding, things like that. And then we do the tax planning. Let's strategize and see, okay, how can we put you in a position to be able to build wealth, to be able to lower your tax liability and put you in a position to where your financial health is very strong. And then guess what? Since we did all that, we can also do the tax filing, right? To where we actually file for the taxes and we represent you in front of the IRS. And we do all the filings for you. And then we also do some of we do the tax resolution as well. Right. So if you have any issues and you're seeking debt relief and things like that, we can help strategize and work and represent you in front of the IRS to be able to help put you in position to where we can clean off that debt. We can help put you in position to where now you can move forward and you don't have to worry about Uncle Sam, on your back and trying to figure out where's his money at. So yeah, that's pretty much what my firm in a nutshell.
Yeah, I love that. And when you think about some of your clients, like what is one of those stories that stand out in terms of like a transformation?
Yeah, I think it goes back to when I talked about when is the right time to seek an accountant. And then honestly, when is the right time to seek a different accountant? Okay. So I remember I had a client, Patricia, and she had an accountant, family friend. She's been going to this person for years. And I mean, I think she's even getting charged a couple $1,000s for her tax returns. And when she came to me, I was like, well, let me just take a look, right? So I looked at a couple of tax returns and I was confused. I was like, you went from 123,000 to now you talk to me, you're at 1.3 something million, right? And then you grew to 3.2 million. And at first she started at 123,000. She was filing as a C corporation. I'm like, why are you a C corporation? Why did you file as a C corporation? You're being double taxed. You just overpaid by close to $46,000 for the past couple of years. And And she was like, well, most people, they didn't even know what their structure is. Let me see your tax form. I can be able to tell. Is it 1120? Okay, you follow the C corporation. If it's 1120, yes. Okay, S corporation. And I noticed that she had been overpaying for about $20,000 per year.
Wow.
To where we can go back and amend some things so she found me. We're able to look back and now, okay, not just go back, but okay, what's the way forward? As you're about to grow from 123 to 1.3 to 3.2 and grow, which is what we want. How can we lower your tax liability? We were able to come up with a tax strategy plan where we created a tax plan over a 5-year period. She was going to be saving well over $197,000 in taxes.
Wow. Okay, Ibrahim, so many people are like, okay, I'm switching over. How can they're going to switch over to you. How can they connect with you, work with you, and talk about some of the people that you typically work with? Are they at different stages or a particular stage?
Yep. So I think I typically, my team and I will have an initial call. You can go to imaccountingllc.com and, go to the services, and there's a lot of different places where you can just contact us and schedule a call. We'll have just a 15-minute call just to be able to understand what your current situation is. Whether you're just getting started or whether you're seasoned and you just want to reevaluate things. You want us to take a look at that. We work with majority of businesses. It's not guaranteed that we're going to work with you. But I like to have the conversation and give free education. That's the biggest thing. I'm a big educator, and I want to provide value to where you feel comfortable with where you're going. So, you go to imaccountingllc.com. And then I'm on all the social platforms. So if you can find me on Instagram at I Am Accounting. You can find me on TikTok, I Am Accounting, or on Facebook, Ibrahim Mohammed, and even on YouTube. You can look. I got to get more consistent, but I went with the.
You do the videos. You do.
I do the video. I went to a spurt where I was going week every week, and I'm getting back into it. It was obviously busy during tax season, but you can follow, subscribe on YouTube. Look for the Tax Huddle. And we're giving out tax strategies and tax advice on a week-to-week basis.
Love it. And what advice would you give to an entrepreneur who's listening, who might be hesitant about seeking that professional help with their taxes?
I mean, I just say bet on yourself. Like if the worst that will happen is you're going to learn, right? I like to fall forward, right? I rather you fall forward than fall backward. Right. And wanting to deal with yourself, you're on the fence. Well, I like to keep it simple. If you're on the fence, just jump off, get off, get off the fence and start to move forward in your life. And it comes by making those uncomfortable decisions. You have to get uncomfortable get comfortable doing what's uncomfortable. Right. And until you do that, as the entrepreneurial journey is not easy. It's a hard road. There's ups and downs. It's a roller coaster. So why not find a professional? Why not I believe, and I might be biased, but I believe accounting is probably the single most important thing that you need in your business. So don't delay. That's how your accounting is how you get access to more money and how you keep your money, how you manage your money, right? It's not about how much money you make. It's about how much money you keep. So seek a professional, get off the fence, and start to move your business forward.
Love it. And as a leader for you, what are some of the tools that you use to stay organized, on task, maybe some books that you read, resources? What would you recommend?
Yeah. So I'm a big reader. I think readers are leaders. So one of the books that I recommend every business owner needs to read, any entrepreneur, go and read Profit First. Read Profit First. That's a phenomenal book. Most people know this book, but if you're just beginning your entrepreneur journey, maybe start off with Rich Dad, Poor Dad. Very simple, easy read. He has another sequels like Cash Flow Quadrants, another phenomenal book. But then as you start, it's like once I started reading those books, I was like, okay, all right, Think and Grow Rich. I started listening to a lot of Napoleon Hill. But I think getting started, the two main books that most entrepreneurs should read would be Rich Dad, Poor Dad, and Profit First.
Love it. And my final question is, what does it mean to you to be Black in business?
Yeah, absolutely. I think I wear it as a badge of honor. And I'm super excited for our community being able to show that we're not one dimensional, right? We can do all things, right? I'm a believer. We could do all things through Christ who strengthens you, right? And I firmly believe it might be cliche sometimes, but I'm like, chosen for something great. But the biggest thing is people live in that potential phase, and there's just a mentality sometimes to where it's going to come to you, right? Just by you just being, but we have to get access to what we were called to be able to get access to. So we have to step out on faith and just get our feet moving, right? Faith without works is dead. So we have to get moving because we were called for something greater. And I accepted that challenge. I wanted to be one of the people that's out front, and I can bring along people. And I say, hey, come on, let's go make this happen, because we were called for something bigger.
Ibrahim gave us the tax word and the word. We appreciate it. Thank you so much for all the things that you've shared with us today. I've learned so much. I got notes. And just thank you so much for the work that you're doing and being a true educator. And thank you for being on the Black to Business podcast.
Absolutely. I do have an event coming up. If you want some more information, this coming Tuesday, if you go to www.taxfreelifestyle.info/masterclass, I'm going to be hosting a masterclass. So I'm going to dive in. If some of the information stood out to you today, there's going to be even more in that masterclass on this coming Tuesday, where you're going to get a lot of information just from your business in general. And I can get diving a little bit deeper with some of the conversations that we had. And then I do have a bunch of resources, an ebook. If somebody's looking for it, they can go to smallbusinessplaybook.info/order. And I give a lot of free game, all the ebooks. If you're a reader, if you're a listener, and you want some of the resources in the templates and the spreadsheets that I talked about, you go there and you'll be able to get access to that.
All right. Now, this was a great conversation. Ibrahim really schooled us throughout this whole conversation, and we learned so much. So let's talk about it. We learned about the common tax mistakes that we should avoid as entrepreneurs, the critical difference between deductions and credits, and he even let us in on the Augusta loophole for some neat tax-free rental income during the masters. And also some of the major takeaways for me, as always, is definitely the importance of keeping those records straight. And I'm so glad that he shared how long you should keep your records, what he recommends. And timely filing is key to avoiding unwanted trouble with the IRS. We don't want that. And of course, a big shout out to Ibrahim for being so generous with dropping valuable insights and breaking it all down for us. And I love this because this is why we do what we do, to serve you with that information that is valuable and that you can actually apply to your business journey. So with that being said, I want to thank you for tuning into today's conversation and being a part of the Black to Business family. To learn more about Ibrahim and some of the resources that he mentioned, his masterclass, his workshops, please check out blacktobusiness.com/208. And I will see you back here next week. But until then, keep building and keep pushing the culture forward. Later.